I will discuss elaborately the topics given in the following table. Number 1. Fundamental of foreign exchange. Derivative as per underlying asset. Currency derivative, equity derivative, commodity derivative, interest rate derivative. Derivative product, forward, future, option, swap. Derivative participants. Number 1 is speculator, hedger, arbitrager. Portfolio management. Table of content. Fundamental of foreign exchange market, security, currencies, currency pair, base currency and quote currency, interbank market, interbank rate IBR, card rate, interpretation of USD INR, spread. Next come cross rate, international role of USD, market liquidity, market efficiency, market direction. Bank for International Settlements BIS, direct quote and indirect quote. Bosro account, Nostro account and Loro account. Factors that influencing exchange rate, currency risk. Transaction exposure, translation exposure, economy exposure. Underlying asset or security, derivatives. Fundamental of foreign exchange. Day by day, the international trading is growing in the form of export, import or any other allied activities. Any other allied activities means when a student going abroad for study purpose or person going abroad to avail medical treatment or tour purpose, all of them have to pay their liabilities in foreign currencies, that is in dollar, euro, pound, etc. On the other hand, when person living abroad remit his part of his income to India in foreign currency like dollar, it will be converted to domestic currency. These are all other allied activities which involve foreign currency transaction. Now come to main point, cross-border trading, that is trading between two countries. The export and import of commodities are based on the realization that everything cannot be produced in each country or cost of production of certain goods is cheaper in some countries than others. Some countries are rich in minerals and precious materials and some are in agricultural products. The resources of one country, when it is available in plenty, the surplus amount of goods after meeting the entire demand of the country is exported to other countries who in reverse import these items where it is found shortage, with an object to satisfy the total demand of that country at competitive price and also of high quality, facilitating economic growth of that country. A brief list of commodity goods which are traded by exporter and importer is given below. Agricultural goods, wheat, sugar, jute, cotton, maize, coffee, etc. Metals, aluminium, steel, copper, nickel, lead, etc. Energy, crude oil, natural gas. Bullion, gold, silver, platinum, diamond, etc. Capital goods, machine parts, tools, computer, etc. The exporter and importer is also traded service in the form of various types of consultancy jobs such as IT technology consultancy, marketing consultancy, financial consultancy, software consultancy, etc. Export means sales of goods and services that involve inflow of foreign fund, increase in revenue of domestic entities, facilitating economic growth and forms a part of national income. Import means purchasing goods and services and bringing them from foreign country to home country for domestic consumption that involves an outflow of foreign fund and forms a part of national expenditure. Government encourage exports by implementing many policies in their favor like subsidies, tax relief, etc. because to increase GDP. GDP means gross domestic product, and subsequently it improve economic growth. This also increase the foreign exchange reserve. On the other hand, government generally discourage import by imposing duties, taxes, etc. to protect the domestic industry for national interest. Too many import than export may distort nation's balance of trade that can have a negative effect of a country's exchange rate. A healthy economy is one where export and import are experiencing growth. A high level of import indicates robust domestic demand, and a growing economy like crude oil, productive assets like such as machineries and equipment, etc. Crude oil after refining is used as a major source of energy, generating heat and use as fuel to airplanes, cars and trucks, and thus play a crucial role in development and prosperity of a country. This will add logistic value. The goal of logistics is to meet customers' requirement in time with cost-effective manner by making a network which link manufacturers, suppliers, wholesalers, retailers and consumers, and is therefore become a key component in the supply channel. This has favorable effect on business and economy of the country. For your information, in financial year 2020, the imported volume of crude oil in India was 226.95 million metric ton, and in financial year 2021 it was 196.46 million metric ton. Now come, if the imports are of productive assets such as machineries and equipment, this is also favorable for a country since productive asset will improve the economy's productivity over the long run. They have reaped advantage like cost reduction, better quality and increased productivity. The imported value of machineries in financial year 2021 was rupees 2225.18 billion, and in financial year 2022 it was rupees 2977.68 billion. Regarding imported value of computer hardware in financial year 2021 was $10.43 billion, and in financial year 2022 it was $15.17 billion. Data taken from Statista.com. Thus you see the high level of import indicates robust domestic demand for growing economy. The growth in international trade resulted in evolution of foreign exchange. That is a system by means of which the importer remit the price to the exporter because the currency of two countries is different. For example, the official currency of India is rupees, and country's monetary system is based on rupees. And in USA, the official currency is dollar. The country's monetary system is based on dollar. Now come, when money is branded, it is called currency. Foreign exchange means the conversion of one country's currency into another. Whenever there is a cross-border trade, there is a need to exchange one brand of money for another, and this exchange of two currencies is called foreign exchange or simply Forex. The rate of exchange vary from time to time depending upon several factors. I will discuss these factors later. For example, when an exporter sells one machine to an importer of USA worth of rupees 5,60,000 in India, but for the importer it will be $7,000. Just converting INR into dollar by dividing the price in rupees by the exchange rate, say rupees 80 per dollar. Here, rupees is denoted by, is called fundamental currency, and dollar is called invoice currency or transaction currency. When the exporter receives dollar from importer, he will convert it into INR by using the prevailing exchange rate at that time. The foreign exchange market is the largest financial market in the world. As per survey report published by Bank for International Settlements (BIS), trading in over-the-counter OTC. OTC means it is a forward contract which is executed between two parties through a linkage with banks, authorized foreign exchange dealers and brokers via a network of telephone, computer terminal and automated dealing system. It is not traded in exchange platform. Now come trading in over-the-counter OTC. Foreign exchange markets reached $7.5 trillion per day in April 2022, which is 14% higher than the amount in April 2019, where trading executed in OTC foreign exchange market was $6.6 trillion per day. Every 3 alternate years, Bank for International Settlements publish this survey report. For example, in April 2016, the trading executed in OTC foreign exchange market was $5.1 trillion per day. Come to the point, there are 180 currencies in circulation today recognized by BIS. But just 10 of them make up over 90% of all trades. There are multiple factors impacting the value of currency at any given point of time. Some factors are originated from the country, which is called internal factor, while others could be from global market, which is called external factors. Now come internal factors. Internal factor consists rate of interest, rate of inflation, current account deficit or surplus, public debt, intervention of government. External factor consists price of crude oil, value of USD against other currency pairs, geopolitical risks. I will discuss in brief all the factors of interest, internal and external. First, interest. In an idealistic condition where all the other factors that contribute to the value of the currency remain constant, an increase in interest rate in a country would cause the value of the domestic currency to rise. That is, higher interest rate in a particular country offer investors a higher return relative to other country and they invest in it more heavily. This higher rate of interest will attract more foreign capital or fund. Hence, the value of the currency will be appreciated owing to growth in demand of that particular currency for higher rate of interest. In the case of lower interest rate, which will decrease the currency value, since the low interest rate will not attract foreign investor, rather they will prefer to make investment to the underlying asset of other country having higher rate of interest. Underlying asset includes stock, bonds, commodities, interest rate, market index and currency. When rate of interest increase, this will have an adverse effect on economic growth and also have an impact on business of the country. You see, when the rate of interest increase, the value of the currency will be appreciated. But at the same time, it will have an adverse effect on economic growth. Whereas when the rate of interest decrease, it impacts the value of the currency but have an favorable effect on the growth of the economy. When interest rate is higher, money becomes more expensive to borrow, causing the businessman to pay more interest on their loans from their earnings, which decreases profit. They may decide not to start new project or expansion during the period of high interest rate, which hamper the growth of the company. So, when interest rate increases, it impacts both economy and the stock market because borrowing becomes more expensive for individuals or businessmen. Interest rate for short term depends on demand and supply of money, and for long term it depends on inflation outlook, capital expenditure made by industry and business. The central bank uses repo rate, reverse repo rate and bank rate with commercial banks to monitor and control the cash flow in the market. RBI lends money to commercial bank during the financial crisis of bank at repo rate with collateral securities. The securities here, the government bond or treasury bills, etc. That is, the commercial bank borrow money from RBI by selling securities with an agreement to repurchase the securities on a certain date at predetermined price. This price is obviously higher than the selling price of the securities. When commercial bank has excess fund, they can deposit the same with the central bank and earn interest reverse repo rate. The central bank uses repo rate for commercial bank to inject liquidity into money market and reverse repo to absorb excess liquidity from money market. Repo rate is higher than reverse repo rate. Now come bank rate. Bank rate is the lending rate at which commercial bank can borrow fund from RBI without providing any securities. The bank rate is usually higher than repo rate as it is an important tool to control liquidity in the money market. It is also known as discount rate. When bank rate is increased by RBI, bank's borrowing cost is also increased, which directly affect the lending rate offered to the customers, restricting people to avail loan and has an adverse effect on overall economic growth. Whereas increase in repo rate is usually handled by the banks and does not affect customers, as banks need funds for a host of reasons, including mandatory reserve requirement. At present, repo rate is 6.50% and bank rate is 6.75%. Previously, the repo rate was 6.25% and bank rate was 6.50%. When RBI increases repo rate, it has an effect of corresponding increase of bank rate. Bank rate caters to long-term financial requirement of commercial bank and repo rate focuses on short-term financial needs. Next comes base rate. Base rate is the minimum lending rate below which a bank is not allowed to lend fund. The base rate is determined by Reserve Bank of India. Base rate is always higher than the bank rate so that the bank earns profit from the spread between the two rates. That is, they pay interest for borrowed funds and the interest they receive from lending, and it is recorded as net interest margin NIM. At present, repo rate is 6.50%, reverse repo rate is 3.35%, bank rate is 6.75%, and base rate is 8.65% to 9.40%. Next comes inflation. Inflation is a general increase in prices. It is measured by the Consumer Price Index (CPI). If inflation between two countries is same, the exchange rate of two countries does not change, provided all other factors that contribute to the value of the currency remain constant. If the inflation in one country is higher than the other country, then currency with higher inflation rate loses value and depreciate, while the currency with lower inflation rate appreciate in the foreign exchange market. When inflation rate goes up, the rate of interest will also increase to taper the inflation rate and try to bring down it to target rate. In USA, the target rate is 2%, and in India it is 4%, with a band of 2% in either direction. That is, the range will be 4% plus minus 2%, that will be 2% to 6%. So, the rate of interest and rate of inflation have a direct relationship. That is, if one increase, then other also increase. A sudden surge in inflation rate in USA prompted a change of Federal Reserve monetary stance. The status of Federal Reserve is central bank. In 2021, the cost of living in USA as measured by the Consumer Price Index rose from 1.4% in January 2021 to 7% in December 2021, and in June 2022 it reached 9.1%, the highest increase in annual living cost since 1981. Federal Reserve has started to increase aggressively the interest rates for taming inflation and has raised rates a total of 11 times since March 2022, in an effort to significantly reduce liquidity in the financial market and tamp down high inflation. The interest rate in US is now in the range of 5.25% to 5.50%, and the inflation rate comes down to 3% in June 2023. As the Federal Reserve tightened the interest rate, there was decline in economic growth. That is, in the year 2022, GDP growth was 2.1%, declined from 5.90% in 2021. This aggressive increase of interest rate to curb inflation have led fund flow to US once again, leading to large scale appreciation of US dollar against most other currencies. Investors also view that the Federal Reserve policy stance is more credible than that of central banks of England and Euro area. The Monetary Policy Committee MPC of RBI has raised repo rate by a 250 BPS, that is 2.50%, and BPS means basis point. 1 basis point is equivalent to 0.01%. Now, from May 2022 to February 2023, to tackle elevated inflation rate, now the repo rate is 6.5% and the inflation rate comes down to 4.81%. Today I stop here. Next day I will discuss the remaining factors of internal and external and also the currency. Thank you.